Welcome to another episode of Unscripted, presented by LeaseLock. In this episode, I'm joined by Jeremy Thomason, Managing Principal at Convolo Capital. Convolo Capital invests in workforce housing in the DFW market and has a specific focus. See, Convolo is a Latin word that means fly together, and our discussion centered around how owners, service organizations, and residents can fly together to deliver superior living experiences. Convolo has a heart for ESG investing with a focus on the S, social, but also service. See, Jeremy is a longtime industry veteran and approaches providing these resident benefiting services from multiple angles, an approach I both learned from and actually really appreciated. So before we get unscripted, I am afraid I have to get that highly scripted and remind you that the views and opinions expressed in this podcast are those of the individual hosts and guests and do not necessarily reflect the official policy or position of LeaseLock. The content is intended for general informational purposes only and should not be construed as professional advice or endorsements. While we strive to ensure that the content is accurate and up to date, LeaseLock makes no representation or warranties of any kind, express or implied, regarding the accuracy, completeness, or liability of the information discussed. The content is provided as is, and LeaseLock assumes no responsibility for any errors or omissions. Listeners should consult with a qualified professional before making any decision based on the content of this podcast. The podcast may include references to third-party sources, which are provided for the convenience and informational purposes only. LeaseLock does not endorse or take responsibility for the accuracy or reliability of any third-party content. In no event shall LeaseLock, its affiliates, or any of its employees, officers, or agents be liable for any direct, indirect, incidental, special, or consequential damages arising out of or in connection with the use or reliance of the content of this podcast. Now, with the highly scripted disclaimer out of the way, let's get unscripted. Well, Jeremy, thank you for doing this. I'm going to tell myself again, because we've had this conversations once before, and I used a completely rookie audio engineer, namely me, and it just didn't come through the way I wanted it to. So thank you for sitting down again. So just, I guess, let's start by sharing a little about, who you are, what you do, and to frame the conversation for everyone, I really want us to go back to a session that you actually did in NAA Apartmentalize that I thought was tragically underattended. And we're really going to talk about the S and ESG, but give it your perspective first from where do you come at this from a business perspective?
Yeah. So thank you. So this is Jeremy Thomason, and pleasure to be here. I love talking about this topic because it intersects a couple of different passions for me. I have a strong passion for housing, sort of the vocational part of what I do, but I also have a strong passion for people, and people that may need help in various forms. And so, lodging, housing is obviously it's a core part of what everyone needs, and so the intersection of housing and social impact, the S and ESG, is really a sweet spot for me. And so the panel that you were referring to was really sort of calling out the part of ESG that often gets forgotten. Yeah. Everybody likes to talk about it in the sense that it feels good, but there's a lot more than just feel good around S. There's lots of metrics on the E and the G sides of it. And there actually is some metrics that you can track on the S side too, but it's usually more of a feel-good story, and it just sort of gets patted on its head and we talk about the other things. But that's not my point of view with it at all. I really have a strong passion for how to help people, and in helping people, it's actually really good for business.
Yeah, this is the part of the panel that I truly wanted to kind of extract and pick out with you. And I'm with you. I've been in this business now for 30-ish years. And one of the things I've come to love about it was I did love it at the beginning because of the service aspect of it. We had to provide people's homes. I want you to talk a little about what you do from your business perspective, but also you hit on the other side of that is we also get to provide people's retirement savings and that growth. And you kind of are running a business that's kind of doing both sides of that equation, right?
Right. So, obviously, there's capital that's needed whenever you're talking about most businesses, and housing is one of them. And so one of the things I was trained as a finance person, a banker, and so a little bit of my background I think is helpful. I was working in lending for many years, But my parents, my dad in particular, had a rent house whenever I was growing up. And that was more of a just accidental landlord thing. We moved and we kept the house, but he was a landlord.
I think there's a lot of people with sub 3% interest rates that are falling into that category now.
That is true. Absolutely true. And so maybe subliminally, as a 10-year-old, as a 15-year-old, that was just always a part of it. And so after I had graduated from school and moved back to Texas 20-something years ago, I bought a rent house in Allen. It was a foreclosure. And that really started my side hustle journey because I had a W-2 job. I was working at the time at Citibank and then eventually GE Capital, working for big institutional companies as a lender. But I was passionate about my side hustle, which was rent houses. And I kept buying rent houses. And the story is a long story, but the short version is the side hustle just kept getting bigger and bigger and bigger. It eventually came into multifamily. At some point, I started passively investing in multifamily deals, large multifamily deals, exposed to a lot of great people in the industry. In 2017, that passion for the industry got me recruited out of banking. And so I started working in the multifamily industry on the supplier side. I got exposed to great companies and great people along the way. Then I realized, hey, I'm actually smart enough to put deals together myself. And so then I started sponsoring and syndicating deals, raising capital, which is sort of where the tie into the friends and family, even institutional capital deals have people's retirement invested in it.
Yeah.
And so this is when you start talking about where sort of Wall Street meets Main Street, it's not just a story about providing housing for people that can't afford to buy a house that are going to live in an apartment, but it also, the deals that are put together actually have money from retirees or from people that are have control over their retirement savings or just their discretionary income, and they want to diversify. And so now you're talking about people like my parents that are now investing passively in deals, and sponsors and syndicators court that kind of capital. And even the large institutions that put funds together, they will court that kind of capital. So even the large institutional, $100 million apartment deals have components of people's retirement, working class, sort of the Main Street type of folks that are actually investing in apartments. And so it's more than just the resident themselves that's a part of this ecosystem, because there is a large chunk of Main Street capital that is involved in these deals, albeit they don't own it outright. They own a fractional piece of it, but it's a great diversification tool for people to invest in real estate.
Yeah, I completely agree. And I've kind of taken a little bit of that path myself, not to the same level that you have. And we could probably do an entire episode just on that and hopefully help change that narrative a little bit that's out there. But that's not what we're going to talk about today.
Right.
Again, when I sat through that session with you and Marcy Williams and Janine and others, I really was taken by the approach you had to thinking about the ESG from truly an investment perspective.
Right.
Not just, hey, we're going to invest in people as social. It's truly a part of some of your actual investment thesis.
Right.
Talk to me about how you got to that point and what are some of the vehicles that you're leveraging and that others might think about if they're getting serious about ESG. Because to your point, it's super easy to measure the E. That's well, maybe not easy, but it's certainly much more feasible to measure the E. But there's absolutely ways you can do it around S and be doing it with good intention. And to your point, doing it in a way that actually benefits financially the deal itself. Yeah.
There's lots of different ways to take this, but I think the most poignant example is one of my previous employers, CAF Capital, based in Frisco. They've been leaders in the social impact sort of story for quite a while, really before the ESG acronym was sort of mainline that people knew about. Right. They just simply called it social impact. And it really got to the heart of the people that ran that firm. And I was one of their executives, really had a passion for people and recognized that the passion for people can translate into good business. They court institutional capital. And so it's interesting in that world, there's a lot of Wall Street type companies that are often beat up in the headlines because they're Wall Street. They're banks.
Right. Yeah, absolutely.
And so what's not known a lot of times is that they have whole divisions that are investing billions of dollars in programs, in this case, multifamily housing, that actually has a social impact play, a workforce housing play, a affordability play. There's a lot of terms that we use.
Sure.
A lot of them have stigmas, especially the word affordable.
Well, yeah, and that's where people would say, okay, it's affordable with a little a, not a big A.
Correct. So you almost have to sort of define, because you don't want people to just immediately tune you out whenever you use one of those hot terms. But the idea is that if you're in that bucket of renter by necessity, you really can't afford to buy a house in that way. That renter by necessity bucket, there's a lot of other social network kind of things that are needed to potentially help those folks out. And CAF recognized that many years ago. And so I got to sort of see firsthand the vision that Chris Faulkner, the CEO and founder of CAF, had for this. And as we were then pitching to capital providers, it was interesting how many of the large institutions had sort of the same thoughts. And they actually earmarked certain parts of their business to focus on this. So that all means, hey, at the front of a deal, if you're looking for a type of deal that might be a workforce housing deal or a renter by necessity type client base, what are the things that you could do as a part of your business plan before you actually are owning the property? You actually capitalize for it up front, either with money set aside in your overall capital stack, or grants that you can go get, or partnerships with nonprofits that you can go seek out. Interesting side note, I go to a church, and we had this discussion at one of our leadership meetings about how can the church get more involved with apartments. And I was like, that's so interesting because you have a whole faith-based community, and it doesn't matter what religion we're talking about, but you have a whole faith-based community that is actually having meetings about how do they get into apartments better to be able to provide needs. And there's roadblocks because they don't know how to get there. And yet on the ownership side, the property management side of things, a lot of times you'd be open to it, but it's not really a high priority for you. And so it's like there's this need and this want, and there's this need and this want, and sometimes it's just connecting those things.
Correct.
And then it can proliferate in ways that really help residents. And so CAF recognized that, and several years ago, one of the coolest stories that I can tell about how you see social impact work out was a partnership that they put together. I won't say which property, but it was here in Dallas, where the idea was we had a large property that had some extra space that we could reposition one of the clubhouses into a learning center. And we partnered with a nonprofit called Kids U. We weren't experts in how to do childcare, daycare, tutoring, but there's nonprofits that are out there that are.
This is the part that fascinated me when you were telling this story. So I'm glad you're getting into this. And we'll for the listeners, we'll put the link to Kids U in the show notes. And I always love saying that because I have nothing to do with the show notes. Right. So it's like, producers will go ahead and do that. But yeah, continue on the story, because this is exactly where I wanted you to go, was this idea of, how do we utilize the space that we have? And I mean, how many conferences have you been to where the question comes up, what are the amenities that people want now? How do we repurpose the space into like this? We happen to be in kind of a Spaces style rental space. So forgive me for interrupting, but keep going down this path.
Yeah. So just a sort of a snippet, just it can be inspiring, is like, what if you actually set aside enough money to reposition a piece of your property that looks like a school whenever you walk in that clubhouse. And then you bring a partner in that knows how to do after school care, tutoring kinds of programs, and you make that an amenity. Talk about a game changer. Yeah. Because a lot of the work, the renter by necessity world, you're dealing with lower income people in general. Lots of times they're either single parent households, or if they're dual parent households, they're still both working. Yeah. And so when school's out at 3:00, there's a gap, 2 or 3 hour gap before mom and dad come home. And this is like classic latchkey kid kind of stereotype. And what would happen if instead of just going home, if you're in the 4th grade and sort of being on your own, what would happen if you just went to the kids' youth center in the community that you're living with, already in, and they have teachers that are there that are going to help you with your homework. And you're going to have laptops to be able to do research, and you're going to have field trips from time to time to go see cool things. What would happen if you can bring that holistic sort of view? Well, I'll tell you what happens, right? It becomes an amenity that is irreplaceable. And in CAF's strategy, that's not something that you have to pay for. If you live there, then and you have school-age kids that's fit, then it's an amenity that you are eligible for. And the only constraint is the fire code on how many people can be in the building at once.
Yeah.
And so it really then becomes a really, really great amenity, if you want to call it that, but it's just a really helpful for those kids that have a higher probability of getting left behind. And so not only are they not left behind, they get a leg up because they're getting that extra care. It keeps those kids from getting into trouble, which is what will typically happen whenever you are unsupervised for a few hours every day. And this is where it's really starts the business side of this works. The statistics on renewal rates.
I was just about to ask us to go to metrics on that.
It's off the charts. I mean, you're never going to have over many years 100% renewal rate because life happens. Yeah. But the first year of deployment, this is 4 or 5 years ago, we had 100% renewal rate with anybody who was in the program. And that renewal rate stays well north of 85, 90%, which is off the charts. You've done plenty of podcasts where you talk about sort of the hidden costs of vacancy.
Yeah.
And so if you can figure out ways to renew your residents, and not just renew your residents, you create community there, and they're going to be referring their friends and family to come live there at every opportunity so they can have access to something like Kids U. That's just really good for business all the way around. And you can put real metrics behind it. If you're that kind of person, if you want to start doing KPIs on what are renewal rates for our communities that have a kids youth center in them versus ones that don't, and a whole host of other types of metrics around community that you can actually do. It's pretty powerful stuff from a business point of view. If you're just looking at it that, and you're not even doing any of the feel good part of it, because it does actually feel really good to help people.
Oh, I'm sure. Yes, it absolutely does. But I keep going back to the renewal metrics that you shared. 'Cause you shared that last time, and I was literally blown away by it. Because I've always been at the camp of, 30% of your residents are going to leave no matter what. As you mentioned, life changes, right? 30% are going to stay probably no matter what. It's that other 40-ish% that you're fighting tooth and nail for to try and keep. And especially on workforce housing, you're going to hold long term. The less you can turn over, the lower your expense burden, the better the overall financial performance of the property.
100%.
So let's talk about, not to get too in the nitty gritty, because again, it's, you're not with CAF anymore. I don't want exposing there. But when you're thinking about converting a clubhouse, what kind of effort went into converting that clubhouse to a usable space that a Kids U program could do? I would imagine that I'm going to call them TI, the tenant improvements on that, weren't incredibly high on that one.
Yeah. Obviously this is very specific to whatever that particular location has, but I would say conversion of a clubhouse, that sort of starts with, you're probably going to have a pretty scaled property to begin with, meaning several hundred units to have that kind of opportunity.
Yeah, not many have an extra clubhouse.
Right. and this particular one was there's 1,000 units at this one community. It was probably 4 communities originally that all sort of came together.
Right.
And then another deployment of this same strategy was a 600 unit community. So the bigger communities will potentially have footprint for that kind of thing. But I would tell you that just be creative, because there's a lot of communities, especially 80s product, that have tennis courts. And so if you're not going to convert it to a pickleball court, you could actually convert it and put even like I'll say portable, but put sort of a building there, and that becomes your Kids U center. So there's a lot of different creative approaches. And there's great groups out there. Apartment Life is one of them. There's a bunch of different approaches where you can actually take a unit and use a unit to deploy some of these kinds of strategies too.
Well, and essentially, I don't know if you saw it recently, but Freddie just came out that for Entryway, which if people aren't familiar with Entryway is a program that really provides job training for people to come into the apartment industry from homelessness.
Right.
So they've actually now, Freddie has now declared that units that are being dedicated to Entryway are actually not going to be part of the underwriting. They're actually allowing you to pull those off of your rent roll.
Wow.
Or probably actually, David, they're actually putting those at rent roll at full market value, essentially, for the valuation. I have hopes that they would do something similar with Apartment Life too. I know you and I are both big fans and supporters of that organization as well.
Love Entryway, love everything about what they do. Great example of, if you have this mindset, there are programs like Apartment Life and Kids U and Entryway and a whole host of others that are out there that are not that hard to go find once you start thinking that way.
Yep.
And those folks that are running those organizations, they really want to partner with apartment owners and managers. And it's just another great way to feel good. And those programs are usually very good for business too.
Yeah. I mean, I probably the most experience with Apartment Life out of the two, although Apartment Life has been around a lot longer than Entryway as well. But for those not familiar with it, not to make this an advertisement for Apartment Life, but we're going to describe a little bit about what your experience with Apartment Life is and what they do and the value they bring.
Yeah. So Apartment Life, it's been around a long time. And so they sort of take a holistic view of what is it that resident needs in terms of community. And then they connect the dots is really what they do. It's one of those things that has been a good idea for a long time. We're not talking about ideas today that are revolutionary new ideas. It's just really giving a voice to some good ideas and showing that whenever you actually you have this mindset, it's not all business, but it really helps business.
Yeah, for sure.
So you can actually have the best of both worlds. One of the things that we would do at CAF, it's not all about Kids U. We would survey our residents as we were taking over the property. And it might not be a community that has a lot of kids, but it still might be a workforce housing community. So what are the kind of things that rent roll needs? Well, they need financial literacy classes. They need nutrition classes. I'm
so glad you bring this up.
They need tax preparation. They might need citizenship help. There's a lot of different ways to help that aren't necessarily all about kids. And guess what? There's nonprofits that will come in and provide these services for free to the owner. These are holistic things. There's just so many of them. I mean, I was on the board of the YMCA and they have a really cool program that's all about safety around water. And the YMCA will come to apartment communities and teach kids how to swim. And they do those programs for free. And so there's just, when you start thinking about it and doing a little bit of research, you'll end up with a list of a dozen potential strategies that can work. And they're all around that S.
Yeah. I fortunately being on this side of the business for as long as I've been able to have a window into a lot of different people's businesses and operations. And there's one I'm thinking specifically that is very heavily involved in affordable housing, big A, not the little a, the big A.
Right.
And you mentioned the financial literacy. There are so many grants in the affordable space for being successful at progressing people along a financial journey.
Right.
One of the things that they do on that side is, they obviously recertify everybody from the TIC perspective, but that gives you a window into all of your residents' financial stability and financial ability. And there are grants that if you can, take your resident base and take them from one level and see them progress up, there's a lot of money available to do that. So they do bring in things like the financial literacy and the tax preparations. And you bring up such a good point that this is not rocket science. It doesn't cost a lot of money. In fact, a lot of these things we're talking about cost zero money.
Right.
Apartment Life, sure, you might have an operations or an event budget, and you've got a team on site, so you're giving up the revenue potential of that one unit. Like I said, for Entryway, you're getting credit with that from Freddie right now. the research part. It's just the time and attention to do it with intentionality.
Right.
So when you were, and I guess you can talk to see if you can talk about your own deals.
Right.
Where, I think I know the answer to this question, but I'll ask anyways. Where in the asset life cycle are you thinking about this?
It's best if you're thinking about it way before, and I deal with acquisitions. And so as I'm touring deals or looking at opportunities, if you have this mindset from the start, then it can be a part of your filter, your deal filter.
Sure.
And that's certainly super helpful. So if you begin with the end in mind, you're in a lot better position. Certainly there are some things that you are already an owner and you realize that are out there and you can implement. But if it's going to involve repositioning a clubhouse or commandeering a tennis court into making it into a kids' youth center or something like that, that's not a insignificant thing to do, and it does involve capital that needs to likely be rounded up from the start. So the more capital intensive, whatever that social impact play is going to be, it needs to be thought through from the start, just like any other big CapEx expenditure would be as a part of a business plan. The ongoing operating pieces of it, a lot of times there's grants that can pay for it, or they're just really, really low cost. And it just sort of becomes how expensive would it be to maintain this program? And is that something that the property's P&L can absorb? And you just sort of build it into your underwriting and your pro forma. And that can work too. Obviously, you can't forget what you're there for, which is better NOI and all of the different things that come with creating value. But for small investments from an OpEx point of view to support some of these programs, many of them are completely subsidized or free anyway, so there really isn't an impact. It's really more time. That is a very helpful part of this sort of economic model that we're talking about. But the bigger things that really do involve the physical asset, the real estate itself, the clubhouses and that kind of thing, they probably do need to be thought through as you're putting your deal together. And there can be some zoning things too that you have to make sure that you stay on the right side of. I will also say this. So we're sitting in Texas, and there's a lot of angst around property taxes here in Texas. And so there's a lot of different plays that different owners are trying to figure out how to combine different programs that involve tax abatements. And the trade-off is usually starts with some form of caps on rents relative to median income, which is a great opportunity. And there's a lot of municipalities that are interested in those ideas. But if you want to get them really interested, start talking about all the social impact that you're going to bring. So it's like a different view. They're used to, a lot of times city people are used to having developers come in and pitch this great idea, and they have to pay for it by virtue of some sort of tax incentive. What would happen if you flipped the script on them in an unscripted way and came in there and said, hey, we want to come to this community and we want to provide nutrition classes, financial literacy, kids, we want to help with getting our residents better qualified to potentially buy mortgages. What if you started the conversation that way? And the community leaders are going to be like, yeah, tell me more. And at some point, then you start talking about, hey, what we'd like to be able to do is put together an abatement program where we're coming in and doing all these social services. Okay, that's a little different conversation than a lot of times a skeptical city manager or city council or whatever their boards are in the development side that are just like, that developer is just trying to get lower taxes. Yeah. And so there's ways to approach this, again, from a business perspective that are not any kind of nefarious ulterior motive kind of way. It really is leading with the good. And when you lead with the good, people feel good talking about good and thinking about how they can actually help their community out. And they'll likely want to get on board or at least know more about it. And then the likelihood of having some of these more impactful economic incentives like tax abatements, as that starts coming into play, the economics are going to jump off the page for an owner in terms of creating value on taxes is just a big one right now in Texas in particular.
So that actually is super interesting that you're going to these town halls and city markets and planning and zoning and being able to present that, especially because I would imagine in your case anyways, as an acquisitions person, we're not talking about a new development. We're talking about taking over an asset that's already in the community,
right,
and having it deliver more value. Have you ever had like significant pushback from those types of organizations in that regards?
I would say this. There is a healthy amount of NIMBYism, not in my backyard, that is pervasive across the municipal governments, and they are reacting to their own residents. So yes, there is plenty of pushback that happens. I'm a big believer in advocacy at all levels of government. So certainly there's things that you do at DC that affect the whole industry, and then there's to a lesser degree that happens at the state level. But the zoning and approval of tax abatements and different forms of incentives at the hyperlocal level, that is city councils.
Yeah.
And what we often deal with there is really good people that are not educated on this at all. And so that becomes there's like a healthy skepticism, I think, that a lot of city leaders will have when a developer walks in the room. Or any form of commercial real estate. They want it from an economic development perspective, but then they're also sort of wanting, what is this guy's angle or gal's angle? And so I think that the pushback that comes is usually, in my experience, born out of ignorance. Yeah. And I'm not talking about stupidity. I'm talking about just not having exposure to the complexities of housing. And so it starts to become to me, the effective way is individual relationships, individual meetings. There's a lot of tools that our industry puts forth to try to educate people on the different tools that are out there. But a way to break the ice is to talk about the good, all of the social impact stuff that you don't have to have a degree in finance or economics or be a housing expert if you're on city council to understand what a Kids U does, or understand what a nutrition class would be or a financial literacy class would be. If you start talking about low-income housing tax credits and tax abatements and how you deal with median incomes and caps on rents and things like that, you can very quickly exceed the level of understanding of a city staff or an elected person really quickly when you start going down that path. So the way, in my experience, to get to those kind of discussions, because you want to be there, is to break the ice with all of the social impact and the good. And it's not any kind of Machiavellian kind of I'm trying to manipulate them. It really is leading with the heart and the soul of goodness. And then once that relationship forms, then you're just like, let me help you understand some of the issues. My guess is that every city and every community across our country right now is trying to solve, or maybe getting a little pressure on, the affordability of housing in general. So these are topics. It is a hot topic. It is a hot topic. So these folks are going to have been exposed to that topic, and that depending on their constituency, they may have pressure to do things. And so you want to be perceived as a problem solver as opposed to a greedy developer that's just trying to come in and get their way on something. I think you can really thread that needle in a better way that's more productive. It might take a while, especially if you're talking about municipal governments. It can be frustrating with how fast they are, and I'm saying that because they're really slow a lot of times. But in the right environment, and certainly in some cities, Dallas is a good example, they have whole departments that are designed around how do we solve affordability issues, and developing relationships with them and getting them excited about some of these social impact plays is a great way to start. Well, and you bring up the advocacy thing, which I think is an important thing to reemphasize, and something my eyes have really been open to probably in the last 2 years or so. The Apartment Association and NMHC are great at hitting on a national level. They really do a good job. I mean, we're getting ready for fall meeting. We're going to have an entire day of advocacy. They've added a day of advocacy to NMHC OpTech this year, where I think the apartment industry hits way below our ability is on the local level. Right. We just don't have enough people out there talking to the local people in different municipalities, myself included. I'm going to throw myself under this bus. And it's something we all
I think to your point, it's a really good way to open that door to talk about the social good that we provide as an industry and as an individual developer, those types of things. But let's keep picking at this S, because there's some other things that we can kind of go down that I think are a little probably more familiar to some of the groups. Like, we talked about, Freddie giving credit for, entryway apartments. Freddie gives credit for something else as well that's pretty that does good, and that's rent reporting. What's your kind of thought on that? Maybe other prop tech that's out there. Yeah.
So one of the things that has been an evolution in the prop tech world over the last 10 years, I would say, is rent reporting. And at its simplistic level, rent payments, which is a form of credit, have not been traditionally reported to credit bureaus.
Unless they didn't make them.
Right. On the very back end of it, yes, it's sort of the hammer part of you're going to end up with a judgment or collections or something like that. But the positive side of it was largely ignored. And so there's been a lot of different companies over the course of the last decade that have developed ways to take that positive rent history and then report it to the credit bureaus, rent reporting. And as you would imagine, 90+% of residents across the country, they pay their bills on time. They pay their rent on time. And what would happen if their largest single budget item in their household budget, rent, was actually reported into the credit bureaus? Well, what happens is what you would expect is that you see some pretty dramatic increases in credit scores for a group of people that probably in general have lower credit scores. And so it's a real boost. And so there's rent reporting. Lots of different types of companies have developed rent reporting in the last 10 years, but Freddie Mac has recognized this, and they've actually come in and said, hey, this is really good from a social perspective. Let's incentivize this. And the way they incentivize it is they'll effectively, whatever the cost to the resident would be for enrolling in a rent reporting program, Freddie has programs in place with providers that will subsidize that. And so, now you have Freddie stepping up and providing really an economic incentive to give a resident the ability to have their rent reported, and that's going to help their credit scores. And as an owner operator, I can talk about that on the tours whenever I'm on the very front end trying to convert traffic into new leases, as well as when people have their rent payments being reported, it's an incentive to pay your rent on time. So there is definitely that aspect too. So that's a good example of something that has evolved out of the prop tech world. Another good example that's near and dear to your heart is in the world of security deposit alternatives. We like the company LeaseLock, the company that you work for. I've been a champion of that company for a long time. And what do they do? They've taken an innovative approach and say, hey, one of the costs to significant costs to move into an apartment is having enough money to be able to pay a security deposit along with all of the moving costs that you have, along with first month's rent. Well, what if there's a way that you can eliminate a big chunk of that out-of-pocket cash flow and come up with a zero deposit alternative, and turn that into a product, a lease insurance product that effectively gives the landlord better coverage than they would have had from a security deposit to begin with, without actually the $1,000 or 1 month rent or whatever it is coming out of pocket for that resident. So it actually helps on the front end drive traffic. It helps with the affordability challenges that people have with just the cost to move. And for the landlord and owner, it helps on the back end if there was a situation where you had a skip or an eviction or damages. It helps protect the property better than what a traditional security deposit is. So that's another example of the way InsurTech, PropTech is sort of helping out. There's just it's almost like endless whenever you really put your mind to how can social impact plays, whether it's insurance, whether it's technology, whether it's good old-fashioned childcare. There's a bunch of different ways that you can do social that are really impactful for the bottom line of an apartment community. social is good for business.
Yeah, no, I didn't mean for this to become a lease lock advertisement, but
Right.
I appreciate you going on that path. And, I guess for full disclosure, you have been a longtime client. You serve on our client advisory board.
Right.
So thank you for all of that. I do want to go back to one thing you mentioned briefly, and we'll probably finish with this one.
Yep.
You mentioned mentioning it on the tour.
Mm-hmm.
How as an owner are you working with your operators and the site teams so that the value of these programs don't just get lost in the shuffle? How are you working with them to make? I mean, Kids U is pretty obvious because
Right.
it probably is in literally the center of the community, I would
Right.
imagine. But how are you making those kind of the center of why someone would go live at a Convolo Capital deal?
Yeah. I mean, I think that you're always looking for what your differentiators are,
Yeah.
right? And that can start with strategy. And so once you've got your differentiators identified, and it could be anything. It could be a really cool gym. It could be package lockers. It could be a lot of different things. Whatever they are, you should be, as an owner operator, making sure that whoever your management company, whether you're vertically integrated or not, that the teams are reinforcing the differentiators. And so if social is a differentiator, social impact programs is a differentiator, making sure that those are not forgotten, because those are nice bullets to have. So that is a culture of making sure that, number one, that your on-site people, which have a high amount of turnover, just by definition, are constantly being trained and reinforced. And companies do that a very, myriad of different ways, but just making sure that your rock star leasing agents are spreading their good vibes to their counterparts and really just sort of taking best practices. And so there's no, I don't think, magic wand that just simply says, hey, we have social, therefore we're going to benefit from it. You have to talk about it.
Yeah.
And so that really starts with, what are your differentiators that are going to make you different from the property that's across the street, and try to keep out of the concession game if you can. And so you're really, this is more of a classic sort of sales training thing. It's like you don't want to talk about price with your client unless you just have to talk about price. So the way you do it is you talk about all the features and benefits, and really try to uncover what their needs are, and make sure that your team is trained on those parts. Because if social is going to be something that you have as differentiators, chances are the communities that are your direct comps, they're not going to have social impact as a differentiation strategy. So it is going to be something that they hear at your place and not at the other places.
Well, and you mentioned a key word in there, and thank you for that. And we'll kind of wrap this up a little bit. You mentioned a key word in there that actually is kind of a tease to the next couple episodes we're going to have as well, and that's culture. Because, you have to build it as a part of your culture.
Right.
The service, if you're going to do service as or social impact, I'm just going to call it service.
Right.
It has to be at every level of your organization, and it has to be, the forefront of mind,
Right.
Not just, hey, how do I put a value proposition in front of me? No, how do I show up and serve every day? We've got a couple of guests coming on the operations side where that's literally the theme of the conversation we're going to have, is building that culture. We've got a guest, Jason Kay, who's coming on, who wrote a book on how do you build a culture like that. So it really is a great tease for those next couple episodes. So again, thank you for I didn't even put the ball in the tee, and you're knocking it out. And thank you for coming in for the second time to actually do this, now that we've got our act figured out. But, appreciate you coming in, appreciate you as a partner, and appreciate you sharing your thoughts.
Yeah. And if anybody ever wants to talk about any of these things, I'll talk your ear off on social. I'll talk your ear off on real estate. I'll talk your ear off on advocacy. Whatever it is. If you're local to Texas and Dallas, let's go have coffee. You can get a hold of me if you go to our website. It's Convolo Capital, Convolo Capital. It's Latin for fly together with others. That is what Convolo Capital is. And we're here to serve. And we're a small firm that is really taking our best practice ideas from all of our experiences over the course of my career and deploying them in a way that we think can make an impact and will be good for our investors. So I look forward to any of those future conversations that might be spurned out of today. And I look forward to the subsequent tease on the future unscripted guests that you're going to have. Those will be great conversations.
Awesome. And we'll make sure that, again, that website's in the show notes for those who are looking for it. But again, Jeremy, appreciate you coming in. Thanks a lot.
Awesome. Thanks, Andrew.